Yeah, this was one of the best and most fun fundraising experiences.
Hey, WeFunder, put in the fun in fundraising.
Putting the fun in fun. I mean, fundraising is just such a mental,
Mm,
I don't know. It takes a lot out of you. I've done it
mm,
3 times, and I'll do it, and I do it for other businesses too sometimes to help out. And like, I will say it is one of the most mentally and emotionally draining processes, the more traditional fundraising path. That was
mm.
the exact opposite of what a WeFunder community round was like. In fact, it was like every day I was getting comments or notes from people that appreciated and loved what we were doing, right?
Hmm.
And so it just felt like great. And then when I got to give updates, that felt great, right? Like
Hmm.
all of those different things. So yeah, no, again, I'm a huge fan.
Welcome back to Venture Capital, a podcast exploring the world of community rounds. I'm Johnny Price, president of WeFunder, and today I'm interviewing the founder and CEO of Nestment. A 3-time startup founder, Niles identified the massive and growing problem of declining home ownership rates in America and determined to do something about it. He founded Nestment to help more Americans hack the outdated housing system and get on the housing ladder. And as a company committed to expanding economic opportunity, it made perfect sense for Nestment to run a community round on WeFunder, which they concluded earlier this year. In this episode, Niles talks about why and how they did it. To check out Nestment's WeFunder page, visit wefunder.com/Nestment. Before we get on with the podcast, we're required to make it clear that anything we say here should not be interpreted as investment advice, recommendations, or soliciting investments in any company. And now, here's Niles.
Niles Lichtenstein, CEO and co-founder of Nestment. Welcome to the Venture Capital podcast, man. Good to have you here.
Yeah, really good to be here. I'm excited to chat, Johnny.
And so you just wrapped up a community round on WeFunder. So we'll talk about that for the majority of this podcast, why you did it, how it went, lessons you learned, advice for other founders who might follow in your footsteps, etc. But before we get to that, maybe you could just give the high-level overview on what you guys are building at Nestment.
Yeah, would love to. So Nestment is building the new on ramps for home ownership, specifically for Gen Z and millennials, right? So we understand and know that home ownership is one of the most desired things. 75%, actually would like home ownership over even career fulfillment, marriage, and kids. But we are at an all-time low in this country of home ownership. We've hit our lowest metric of 24% of transactions are now first-time homeowners, used to be around 36%. And the average first-time homeowner age is now 38 years old. It used to be 31 just 10 years ago and below 30 before that. So we're building all the new on-ramps, which include co-buying, house hacking, rent vesting, some creative financing, just building that pathway for folks to get to ownership based on where they're at in their situation.
So just a couple of follow-ups on that. Firstly, why has you think you said average age of home buyers increased from 31 to 38 in a decade? That sounds really scary. To jump by 7 years in a decade is a lot. So firstly, what is kind of driving that problem? And then secondly, you mentioned a few kind of alternative, I guess, strategies to getting on the ladder: home ownership, co-buying, house hacking. So we'll be curious for you to unpack a little what those tactics kind of look like.
Certainly, happy to help. So yeah, let's start with. So you got 4 decades really of home appreciation, right? So the price of homes
Mm,
appreciating much faster than wages appreciating. So wage growth.
mm,
So as an example, for baby boomers, when they were putting in, a home cost, for them, the down payment was about 35% of their annual income. For a
mm.
millennial, it's 85% of their annual income. Now, also,
Wow.
if you're a millennial or Gen Z, you're also dealing with rent that's usually taking up 30 to more of your income than ever, right? 30 to
And
even
and dumb
sometimes up to 50.
question, but this is just supply and demand. Like, supply of housing is not keeping up with the growth of population?
Yes, so it's both. It is supply and demand. I mean, if you go really deep into it, you also kind of see, in some ways, there's assets have been appreciating at a much higher rate. It's also why you get kind of a polarization of even like losing the middle class in a way, right? You get a lot of wealth that's accumulated passively through equity increases in assets, right? So you have that, and then you've got a lot of people who are not making where wages didn't follow that same trend. But then the supply and demand element is a huge aspect of it. And one of the reasons why it's accelerated is the fact that you don't have enough homes for the demand. You also now have a ton of people who are in low interest rate mortgages, so 2 to 4%, right, for over a decade. um, and now, your interest rates will sit between 6 and 7% for the most part, right? So double, even more than double what it was for some folks. So a lot of people aren't wanting to sell as well, right? I will say though, the interesting part about and that's kept prices high. So now, at first it was just a down payment issue. Hey, how with this high price, how am I able to come up with the 20%? And I will say that the national average down payment, people think it's 20%. It's actually far less. And we can talk a little bit more about that, right? You can go as low as 5% in a lot of situations. There's some great programs that we connect people with in that respect. But then, but now you have your monthly payment being an extremely high amount as well. So there was an article just this morning that said, it's the first time where actually now we finally have more inventory coming on market, but we don't have enough people who can afford to buy that inventory.
Mm. Yeah. So that's the problem, or some of the reasons for the fact that this is a problem that you guys are tackling. You mentioned two or three solutions, creative solutions to how you guys are approaching that problem. So can you just unpack some of those?
Yeah, so we focus on kind of our three major ones. The first is what we call primary multifamily. So there's about 9 million 2 to 4 unit buildings in the U.S., right? And what's unique about 2 to 4 unit buildings is under 5 units, it still counts as a primary residential loan. So you're getting a much better kind of interest rate on it. You're getting primary deductions if you're living there as an owner occupied 2 to 4 unit. So you're also typically buying it at 20 to 30% less per square foot, but you're able to get, market rents for it, right? So there's an arbitrage between the cost per square foot. I'll give an example. I'm fortunate to own a home here, but it's in a triplex that we own in San Francisco, which is a very expensive place. If I was to buy the same amount of square footage that we have on the top unit, I would be paying 30% more than I did pay. And then I'm using the rent from the middle and bottom unit to actually pay the mortgage and property tax, right? So in a world where you can't afford to buy a single family home, this becomes a really great way, especially for younger and younger folks to start, right? To say, hey, I'll buy a 2 to 4 unit building, live in one unit, maybe have multiple people live. We have a lot of multi-generational who will live in multiple units. So that's one way, primary multifamily. And with that, a new Fannie program came out where you can also put as little as 5% down as well. And then you're making up the amount through the rental income. You've got an appreciating asset and a tax write-off. The second is what we
And
call
actually,
rent.
just to touch on that one, so then what's the role that Nestment plays? Where do you come in, and how do you make money as well as the business model?
Yeah, no, great question. So, these ideas are not necessarily new, but what is new is and I've done this now multiple times to make the Bay Area more affordable with family and friends, and we can get into the origin story at some point too, because it really starts from when I was a kid. Um, but what Nestman does is we allow people to tell us, hey, here's my situation, here's what I'm looking at, here's what I have, and Nestman spins up a roadmap right, and says, here are a set of strategies, including what I just mentioned, primary multifamily. Here's how it could impact. And then it will take listings from Redfin and Zillow, analyze those listings. I think we're the only platform that has like a multifamily calculator that will say, hey, if you're currently renting at this amount, you can trade your rent in or pay yourself rent. And here's how much you can get from these other units, right? And here's how much equity you're building over time. So it does the financial projections. If you are co-buying with other friends or family, it puts the agreements together. And then it connects you with the right financing and lending partners. And lastly, connects you with the right agent partners. So see us as the consumer advocate that is helping you really say, we know you want and desire a home. We are the bridge that will help you create the roadmap, build the dream team, and actually get you to home ownership. That's why our tagline is home ownership is so possible. The best part is we don't charge our users anything. We actually make money through a percentage of the agent commission. And then we also have MSAs with, marketing service agreements with different lenders or providers. Now, consumer advocacy is at our core, so we vet everybody, right? So we don't choose to work with just anyone. We vet folks, try to empower folks, but it also gives people the ability to look at multiple lenders without getting a call every single day from Lending Tree, right? Or look
Yeah.
at multiple agents without feeling like they have to use one particular agent, right? So that's how we make, and honestly, we make. People are like, well, you're giving away so much, but we make over $10,000 per transaction at 80% margin, right? So we do well for ourselves. But what I think we've discovered is that there's all of this complexity to make these new on-ramps possible if we can extract the complexity from that. So more and more of the stuff is being automated, but we will never lose having what we call Nestment coordinators who are there as you get assigned to one. So they're responsible, almost like customer success. They're responsible for seeing you through the transaction, and they are there for you throughout the process while the tools and platform are taking you through that process.
Do you work with just boring old, kind of regular home ownership, like just buy a regular
Tons,
house? Or is it like,
tons,
no,
yes.
it only makes sense if you're kind of following one of these more, unconventional, innovative paths?
I'm glad you asked that, Johnny, because we actually work with our focus is first time homeowners. We actually still work with other people who want to buy another home and things like that. But if there's something that we want to solve for, it's get people to that first time home ownership, right? Because that's where generational wealth is built. The other stat that's a little crazy is we're at a historic high for the wealth gap between owners and renters, right? It's about a $380,000 wealth gap in terms of how
Wow.
much equity and owner. And you might go, yeah, well, no duh, because they own a home, but you can see all of these things that exist to keep you renting, right? Versus
Right.
actually owning. So yeah, actually, we joke that 100% of our folks come in for the house hacking and the strategies. 40 to 50% leave just getting a single family home. But what they wanted was the confidence and trust. They wanted to know, is there a program in my area, a down payment assistance program? People are
Yeah.
surprised that in San Francisco, you're actually under 100% AMI if you individually are making less than 170,000, which actually makes you open to being able to get a number of different down payment assistance programs, right? So there's a lot of opportunities there that we help your average person. We also can give them the confidence of having the right agents, the right lenders, and just someone there who's got their back.
Well, I only asked that question because I remember when my wife and I bought our first house, and the whole process was just, I would say, awful. And it was like the biggest amount of money we'd ever spent by like maybe two orders of magnitude, certainly one order of magnitude. And we didn't have a clue what we were doing. And, it seemed like every step of the way we were kind of surprised by something. And it was like for the biggest purchase of our life by a massive order of magnitude, it also felt like the purchase that we were the most like vulnerable and unsure on. And
Yeah.
yeah, I wish we'd been, kind of actively using Nestment to make that journey more easy to navigate and for us to feel kind of more confident and comfortable in making that journey. We made it happen. It worked. Like it ended up working out. But I remember like right at the closing, it was like, okay, here's the closing fees, and it was like, wait, what? I don't think you ever mentioned that like up until this point, which is like, probably if
we hear that a
ChatGPT had
lot.
existed back then, probably would have been a little further ahead, and obviously, like, it probably should have done better at Google. But sometimes it's just like the information is there, but you just need a Sherpa, or was it I can't remember the word you
We use
used,
coordinator, but it's funny.
coordinator.
That's the second time someone has used the term Sherpa in this process. And I think that's a great way to put it. It's funny because closing costs are something we put right up front in when people are doing the financial projections, like, because people want to know how's this going to impact my day to day, my monthly income, like all of those things. The other thing what's crazy is this is probably one of the biggest, industries with the worst NPS score, right, across the
Mm,
board, right? Because
yeah.
the other issue is that you
NPS
have
on agents, you mean?
on agents and lenders oftentimes too, right?
Yeah,
So
I would have given an NPS on our lender of like really low, just because I was like surprised by a
mhm.
huge fee at the end of the process. And you can say it's on me. I probably didn't read the small print. I probably should have researched it better. But whether or not that's true, it was a surprise to me. I don't think the lender had like done a good enough job in setting expectations there, and I think that was deliberate. And you know
Totally.
what? It went through, right? And it's not like that would have kind of derailed it anyway. But yeah, our MPS would have been pretty low.
Yeah. No, I think that's right. And then, on the agent side, people can love their agents, sometimes don't love their agents. Like there's this, and I think, but all in all, I think this should be, to your point, for the amount of money you're spending, right? It
Exactly.
should actually be a premium experience, right? And that's what we're saying kind of to the world. And that's what you'll start to see in kind of a pitch. We, not necessarily from a business standpoint or model standpoint, but we do see ourselves from a marketing brand and consumer interaction standpoint as what SoFi was for student lending for a lot of folks
Mm,
coming out of
yeah.
college. Um,
Yeah.
because what they really did was normalize and even took the shame out of talking about debt and what you could afford, but then also opened you up to this notion of, oh, did you know you could refinance your debt? There's these other products, like things like that, and took you through this process. My head of business development jokes that the only fanboy letter he ever wrote was to SoFi, right? And we would like to think the same thing, like the pictures we get back, the fact that we surprise people when they get pre-approved with a bottle of bubbles they haven't even bought yet, but we know that that's such a big moment where you're having to go through all your you feel like you're being judged even, right, as you're getting pre-approved for a certain amount. And we want to like celebrate those moments and say, hey, yes, there are going to be things that are bring anxiety in this process or feel overwhelming, but how can we reduce those, and then how can we also see this as moments of really taking a big step for everyone. So
Yeah.
yeah.
I love that.
Yeah, and so I mean the other two strategies real quick, rent vesting is something that we talk a lot about. And so this is where you have, like, let's just take, the Bay Area, we have a ton of first gen tech workers who are making great money, but it'll take them 15 years at least to save up for Cupertino or Menlo Park at some point, right? If they want to buy even a primary multifamily. So a lot of folks want to start with, say, a rental property, right? First, that they buy, and they're able to increase their equity over time in that property. The property pays for itself or is slightly profitable. And again, our tools take all of the data, help them think through that process, set them up. And then the last one is just this layer, right, of co-buying, right? So we have family, friends, roommates, cousins. We've had every single open relationships, whatever you want to. We've had every single type of kind of configuration. Because what a lot of people don't know, and what some lenders might not even necessarily tell you, is you could actually have up to four kind of entities, or four co-owners, or four couples on a qualified mortgage. Now, the application you get only has two slots, right? And so when we first started, there were lenders who were like, well, I'm not sure how this is going to work on our back end, but everything states that you can have up to four. So once we were able to work with lenders to do that, And then there's all types of other interesting ways you can think through that process if you have more than four. But there's a lot of these things that I think didn't have to come up 30 years ago, but now make a lot of sense, right?
Hmm. It's really cool. Are you guys a public benefit corporation, by the way, or a C corp?
We're actively looking at that because our mission, we're very, as and I know we'll talk about the community round, like yeah, it's always been part of our mission. I mean, my own story, like I said, was this kind of started for me. It's weird when you build something, how it connects to oftentimes childhood and memories and
Yeah.
things that impacted you. But when my father passed away, my mom was a widowed immigrant and she had two boys, no job at the time. But we were fortunate we had a home, and that home had some equity in it. So at 13, I learned how to refinance a home. My mom was smart and scrappy and said, "Hey, there's a local university. Can we rent out rooms?" So we ended up renting out, rooms to international grad students. And, outside of maybe having to stay in the living room once in a while and sharing bathrooms, it was actually a ton of fun. And I learned a lot from that process. So when I was fortunate to, have a first startup, get acquired and have a bit of capital, my cousins were teasing me that I was the reason they couldn't afford the Bay Area. So we started to, I said, "Hey, how about we buy together?" And so it just started through that process. But our goal is to really give everyone a shot at ownership and putting this as a core part of everyone's, because on the flip side you do have Wall Street, and I'm not beating up on all my friends on Wall Street, but you do have Wall Street financing a lot of new build to rent communities, right? And these are intended to keep people renting as long as possible, right? While the assets are appreciating. And we really want that appreciation to go to the people, and that's what made doing something like this community round so important for us.
Yeah, I love that. You're driving this podcast interview for me. You're just like basically taking on the job of like seamlessly segueing to the next kind of question here. This is great. I should just like put my feet up and let you drive the questions and the
No,
answers
no,
here because
you're the one that has created the environment to do this. So
well, thank you. I stand on the shoulders of giants, being WeFunders founders. But yeah, so as you say, that's Nestment. That's your journey of kind of how you came to found it, and your kind of personal, like I guess, belief in the mission. As you say, community is very central to the whole ethos of what you're building. I guess before we get to the community round, I'm always curious in like the capital journey that you were
yeah,
on leading up to the decision to raise on WeFunder. So, can you talk us through that? Like, did you raise from angels,
definitely.
VCs, etc.? As a second
Yeah,
time founder, oftentimes it's like a little bit easier, maybe sometimes to raise those
yeah.
checks. But what was the journey up until the community rounds launch?
Yeah. Great point. A great question. So we raised, in that kind of frothy moment that was
Mm.
2020, end of
Wow.
2021, early 2022. So like really early 2022 is when we incorporated at the end of 2021, after literally just putting out the other part of the origin story was that, I started to have a lot of, our colleagues. So my second startup was actually a sustainable SaaS company that was funded by the New York Times, and this is my third. And we had a number of my colleagues who were like, "Hey, we want to buy. How did you do that?" Right? And so they came up. I give all credit to them for coming up with the name Nestment and saying like, "Let's test a landing page." I put in some money into some Instagram ads and LinkedIn campaign. All these people signed up for this product that didn't exist. So then we went out there, and you're right, because of a little bit of a track record and so forth, right? We were in a good network. We were able to raise, we started by just, raising, 1.5 million, but that turned into closer to 3 million or so, 3.5 million. Um, and that was exciting, right? That was really a great, and that was pre-seed 3.5 million, no customer, no platform, just some initial tests, right? Really to say like, hey, in this market space, and then to have a team. And so then we went out and started to build. And I will say, we very much we hit all of our metrics. So then we now had, about a year later, year and a half later, 12 to 18 months in between that period, we now had set up, we've built a manual MVP that worked out well. So then we launched a true platform. We had customers. We had just done our first partnership with Built Rewards, and had completely crushed it. Like, we actually had so much demand, we couldn't even service all the demand, right? So I was like, oh, okay, this is exactly what a seed round would be for, right? And I'm giving you the very transparent journey here, right? Because I think this is good for other founders. That was also the
Thank you.
time where venture had completely dried up, right? So
Oh yeah.
interest rates
This
had
this
shot
is
through the
what,
roof. This is
2023 or
now this
24?
is now end of 2020, or like mid 2023, right? So we had hit all of our metrics. 12 to 18 months later, we
What
had.
are your metrics, by the way?
Yeah.
Is it revenue from the
So the first, yeah, so the first of the metrics from pre-seed to seed was basically both, you're starting to generate revenue, right? So you're starting to see, so you've launched a platform, you're starting to generate revenue, and you have a pipeline worth over $1 million of potential revenue, right? So those were our metrics that we had to hit to then say, okay, you've got a seed round, because then we started making, 5,000 a month, 10,000 a month, 15,000 a month, right? As we started to see the transactions come through. And this is also during a time where actually it's one of the worst years in real estate as well. So that,
for
you
like
know,
transactions? Yeah.
yeah,
So to be
yeah,
kind of starting to generate revenue in that time. Although I
completely,
guess that's
completely.
almost a good thing for you, because I would imagine you might almost be counter cyclical. Like, if maybe I guess
Yeah,
you don't
no,
know
no,
this.
you're.
Maybe
I
it's too
think we'll
early
do
to say.
well in a good economy, but actually, we're like the only hope in
Exactly.
when it's not
Yeah.
working well. Like, we are.
Yeah.
So I actually think it helped, and I
When
will
interest rates
also.
go up and mortgages go up, then it's
The
like
only way
harder
to
for
make it
people to
work
get on
is
the
to
ladder.
own together,
Exactly.
or figure it out. Exactly. Um, but what was interesting is that, everyone's powder was pretty much, or they were saving. Frankly, what was happening too is you saw a lot of institutional capital saving, the companies that they really had overinflated valuations, right?
Right.
and,
Yeah.
and
Trying
like,
to do
they're like, how do we
follow-ons
save?
into companies. Yeah.
So there was less for us at that time, and we purposefully had a really wonderful cap table of actually 65% investors of color, because we saw a ton of professionals of color and first gen immigrants,
Mm.
using our system. So had some really great partners, and they definitely helped us through part of that. But it also got us to be really, really thoughtful, and we started to actually go down a path of what does it look like when you have to be sustainable, right? So over
Mm.
the next year, obviously we hit our million in run rate then over that next year, but actually lowered our burn by 20%, right? So, like, now we got to that point, and so now we were at this really interesting point where we hadn't necessarily raised the seed round, but we had a pre-seed round. We're close to sustainability, but we're
Mm.
not quite where, because A rounds had changed now. Like, it couldn't just be
Right.
about a million and a half. You needed 3 million, right?
Right.
So we were in this weird space, and that's another reason why WeFunder. I mean, we'll talk about the reasons why WeFunder was actually a really good fit. And I know I just sound like a fanboy, but
Hey,
there's a
fanboy
few
away,
reasons.
man. Fanboy works for me.
No, there's a few reasons why it provided a great moment for us to say, hey, we're gonna raise the cap on the note a bit so we can get a bit of a bump, right?
Mm.
Um, so I'm going to just take the capital part of it, but it'll give us a way to take in a little more capital, and that will give us what we need to get to this A round, right? Because we
Hmm.
see all the right metrics, but we do need to invest in something like performance marketing. We've never done, it's been all organic now. What
Hmm.
happens when we actually kind of start to target and learn, audience learn and stuff like that? But that
Right.
takes money, right? And so, like,
Hmm.
all of those things, um, start automating some more of the process, like all of those things. So, what ended up happening is something that first was like, hey, should we do kind of a small round to institutional investors? What we always got the comment from our customers going through this as transactions were starting to build: can we invest in you, right? So we got the comments from our customers. We also work with agents and lenders and providers and CPA. Like we
Mm.
work with the whole gamut because we ultimately are that hub that gets people to the right places. And all of them were like, "Hey, can we invest?" But not they weren't all accredited investors, right? And obviously, with all of our customers, we're like, focus on getting your home first, right? Then maybe we can talk about it. So more and more the notion of, if we're going to be about building community and building wealth, we have to live by those values and principles.
Mm.
And WeFunder really provided, I would say, both from structurally, but also even just the way you guys as a team work, and you are very community focused.
I mean,
There was just a
look at my
sense that it
chest,
aligned.
right?
What's that?
Look at my sweatshirt here, right?
Oh yeah.
This is. Have we sent you one of these yet,
No,
Niles?
I need one of those, right? I was
Yeah,
gonna joke, Johnny, you wear that every day, right?
I wear it. I wear it proudly. Yeah, we printed these recently. My colleague Justin did it. He's just brilliant with this kind of stuff. He somehow has
Amazing.
this gift for like merch and just kind of branding. And so he made them. It's got a little W We Fund a tick on the back. I would
Love
have
it.
said community round, but he deleted the round and just says community. And I think he absolutely nailed it. It really means a lot that you, as like, you know, a founder who is trying to put community at the center of everything you're doing with Nestment, that you would kind of see that in how we approach branding and just the communication of what we do. And yeah, we tried to rename it away from equity crowdfunding towards, now we call it a community round. And yeah, it means a lot that you kind of see that. And I guess, yeah, that's probably why you, a big part of why you decided to pull the trigger.
Yeah.
Um, which was, yeah, a few months back, and it was kind of on the same terms as you'd raised. Was it
Yeah.
from
So
angels?
what we
Yeah,
did was we did the first couple 100,000 on the same terms because we knew that those would come from our customers and our partners, right?
right,
And so what was really interesting is, so the three reasons we decided to do the community round. First was live by our principles and welcome our community in. The second was capital could be very helpful right now. We don't need a ton, right? And we don't want a
right,
ton of dilution, but like, it's hard to just go out there sometimes and just raise a little bit of money. It's weird, right?
right,
I actually think it's almost counterintuitive. I'd rather have a company kind of continuing to build versus always having to get this 2 to 3x, right, jump
right.
step every time, right? Um, but we need a little bit of capital. And then the third was also just to touch on it, and then we'll tell about the round itself. Is that it also provided an opportunity to share Nestment with, frankly, a like-minded community
Mm,
in WeFunder investors, right? Like you
mm,
couldn't ask kind of for a better thought. Like there's a lot of folks there who, and we saw this in the comments, who were
mm,
actively either thinking about this, a ton of
mm,
like, let's call it, parents or grandparents who were actually
mm,
like, we had everything from the 20 year olds and 21 year olds who were like, I'm trying to learn how to house hack because I know that's the only way I'm going to afford coming out of college,
mm.
all the way to grandparents saying, I don't know how my kids are going to buy, and my
Yeah.
grandkids are going to grow up in a rental home. So we had all of these people like that came in, through that. And, so we knew it would also be a great potential customer base for us.
And you raised 303 grand. I'm looking at right now from 224 investors.
Yep.
I
Yep.
always love that on WeFunder, as you say, the diversity of it. I think democracy is cool. Democracy is about diversity. You have the grandparents and the younger kids. I hope you get inspiration as I do from reading the notes, right? And people can just invest on WeFunder and that's it. But it's very common. We try to nudge them. Hey, leave a note for the founders and team. Why did you invest? And just reading through some of the comments on your page, it's just really cool. People like really believing in the mission of what you're doing. I saw the first investor note I saw, it just says fan. He's a
No,
fan
it's
of
true.
I don't know if he's a fan of Nestman or a fan of Niles, probably both.
No,
But
well, I mean, and I will say, Johnny, and this, you guys don't get as much credit, I know, from a revenue standpoint, but you guys actually helped us raise close to 1 million, which was the interesting part. Because of the WeFunder round, and you can edit this however you like, right? But like, I honestly think one of the benefits of what you guys are able to set up, and I actually feel like we could have actually we had learnings that we could have done a better job of getting more from the community, and that 300 could have been a lot higher. But one of the interesting things that did happen was then we actually started having outside checks, both like
100%,
high net
man.
worth and institutional. So although there's 300 plus that came from the community itself, and at one point it was actually at 400, and then there are all these little things you learn about, like, okay, here's how maybe we should have gone about, making sure we captured and optimized everybody in there. But I do think that because of you all, it was actually more of like $1 million raise, right? So
Yeah, totally. I'm hearing that more and more, that like it's almost like luck surface area, right? And you're kind of live and you're out there, and it's going out on social and it's going out to your email list. And I'm hearing more and more stories of like, well, someone invested $100, but they kind of referred us over to this other investor that invested 100 grand, or the 100 grand investor saw, oh wow, like all this go to the WeFunder page and like all of this cool stuff, all this customer love, all this kind of community and momentum around this movement. Okay, and it like increases their kind of conviction, and they wrote a larger check off platform. As you say, we don't get the revenue on that, so I have to make the joke every time this comes up. We're like the IRS. We'll be coming to collect on our 10.9% from that. But just kidding.
no,
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 that, I mean,
I
I tell
actually
founders
think
to
it.
do that.
No, I
If
think
you
it's.
like, if you
I
have a
think it's
larger
great.
check, take it
Yeah,
off platform.
yeah,
I think WeFunder earns our commission on the smaller checks and hoovering it up to one SPV. But if it's like a 50K, 100K check, don't pay us the fee on that.
yeah.
Just take that in outside of WeFunder, and we can reflect it in the total on the page. But yeah, I think we earn our money on the smaller
I
check.
think that's a huge benefit, and that's also something that felt great about you all. Like the goal together, and this is how we approach like home ownership. Even, even if for some reason someone, their cousin's the agent, and we're not going to get all the the funds from that transaction. Our We understand the goal and the mission, and the mission
Mm.
is to empower, in your case, empower founders and businesses to do these community rounds. Our mission is to get people in there. And so, but when I think there's ways in which, if people understand and not feel weird about, like, okay, I'm getting some bigger checks off platform during the same period of time, so it's the same
Right,
kind of period of time, and I'm getting WeFunder, how to actually work those things together so that
right,
you increase the amount of community funding. And those were
yeah.
some of the learnings that, like, I've been passing on as I've been referring more. I've got a couple more referrals for you too, that of folks, and that I think there's some really interesting ways to think about it.
Love that. And yeah, just to go back to your point on part of why you did it is to get in front of the WeFunder audience, right? And yeah, if I look at like of the money you raised on the platform, 40% of it came from our existing WeFunder investor base, 60% from probably the Nestment
Yeah.
community users, your audience. But from a number of investors' perspective, it was the other way around. So 64% of the investors coming from existing WeFunder investors, 141 people, and hopefully now they're aware of Nestment. Maybe they'll become users or tell their network to become users. And so yeah, it's kind of awareness building among a very aligned, as you say, kind of probably very much in the sweet spot for you in terms of kind of ICP, target customer
Mhm.
demographic. Yeah, that's a good point. And then obviously delighting your existing. This is kind of the first point, right? You said one, it's aligned with our kind of community ethos. Two, relatively easy way to raise capital and kind of augment the capital. And then three, get in front of the WeFunder investor base. This is kind of your first point, but you might add as a separate fourth point around like building stronger relationships with the
Mhm.
Nestment community and turning them into even more kind of passionate ambassadors for what you guys are building, because
I
you're
think
giving them the opportunity to
you're
invest.
right about that too, right? So I was really surprised and impressed that we had, people who put in as little as 250, but we had customers who put in as much as 20K, right? Or committed 20K. Definitely had a few $10,000 checks from customers. And those have also become referrals, folks, ambassadors.
Yeah,
One of the most
exactly.
interesting facts about how our last three hires at Nestment are all people who were customers of ours, right? Which
That's
is
cool.
interesting. Yeah. So it's people who've actually gone through and explored these new methods of ownership, who are the best, who are the perfect coordinators, who are there and saying like, this is, so it's been fascinating, right? Thinking about it in that way.
Have you seen the list of your investors and like their bios on WeFunder?
No, I haven't, but I should.
Yeah, we can do like a little, product discovery
Yeah.
section of this podcast now, but it's a relatively new feature that we've been rolling out over the last few months. And the idea is that we're kind of asking investors when they're investing in companies, who are you and how can you help? And so I'm joking, we don't need to screen share right
Oh,
now,
no, no.
but
Yeah, yeah, no. I mean, we could do it. I love it.
But yeah, I'm
It's
just
great.
looking through your list, right? And it's wefound.com/nestment/investor_community. And just like looking at who all these investors are.
Mm,
And it's like expertise. I am a mortgage loan officer and real estate investor with experience in residential and commercial. I'm a real estate professional investor. I was a realtor in California before moving to Texas. Um, I, Anything, just ask and help with financing, relationships, partnerships, accounting, or anything in general. I'm a real estate broker and have connections in the real estate industry. I offer marketing
love it.
support in a freelance capacity and make connections within the mortgage and home ownership space. I'm exploring new opportunities in sales and marketing. Um, so, yeah, I've bought and sold 8 single family and multi-family residential properties in San Diego, California, Norfolk, Virginia. I'm like looking down this list. It's like, oh my goodness, this is like just perfect people here to be investors in Nestment.
Totally. And some of these are, some of these are folks that we actually now work with. So,
Yeah.
which has been great. And some of these folks are folks that, and that's what was so impressive, right? Was just like being able to kind of connect out to this community. I mean, honestly, this was one of the best like fundraising experiences
Can you
for
say it
me.
again? I didn't quite catch that. Say it right into
Yeah,
the
this was one of the
microphone. No, no,
the
just kidding.
most.
Love that. And glad I can share this awesome new product feature with you live on this podcast.
Yeah, dude, I'm
That
looking
for
at it
me
right
is
now too. I'm going through a bunch of it right now. I'm
it's
like, oh,
cool, right?
yeah, it's great.
Yeah, a live reveal on the podcast. Yeah, this is very much in line with what we want to build, right? It's like I read a long blog about this on my Substack recently, which is like there should be more community and community rounds, and the way you raise money should be focused on community, and then like the type of companies that are doing it should be focused on community, and then once you raise, it's like okay, this isn't just okay, thank you, we got your money, now we never talk to you again. It's like okay, you've now recruited this army of investors that want to help you grow the business. Warren Buffett, show me the incentive, I'll show you the outcome. Okay, they're incentivized to help you grow. Can we kind of build stronger community around Nestment, around startups that
Mhm.
are raising on WeFunder, and put that investor army to work
Yep. Yep.
in kind of helping you with whatever you need help with? And yeah, it's just really cool to look through that list and see how many investors in Nestment's community round are in the real estate profession. And it's unsurprising as well because
Yeah.
Tyler Hayes came on this podcast a while back, and the founder of Atom Limbs, raised on WeFunder, and he actually kind of was talking about what you were just saying, which is, fundraising typically feels like no, it's a grind. Fundraising WeFunder feels like yes. You just
Yeah.
get all these kind of, supportive notes and messages from investors. It's a very positive experience. But the other thing he said was, raising on WeFunder is about finding people that share your crazy. So
I
for
like
him,
that.
it's like maybe people that lost limbs or military veterans who lost limbs. He's making prosthetic limbs. But for you, it's people in the real estate profession or
Yep.
people who are kind of very passionate about the challenges around getting on the homeownership ladder. And so the kind of opportunity to invest in investment is probably going to really appeal to people that are passionate about kind of housing access. And
Hmm.
so therefore it's probably unsurprising to see if you look down the list of investors, so many of them kind of working in the real estate profession.
Totally.
And so many of the notes on the page just kind of referencing people's kind of interest in space or passion for the mission of what you're building. I
Yeah.
want to circle back a little to maybe end on this, just kind of some notes on like how you did it, how
Yeah.
you executed on it. You mentioned, I think earlier, okay, we learned some lessons about like how we would approach, it if we did it again, maybe raise more money from the community. Hey, next year,
Yeah.
let's roll the dice
Totally.
again.
No, I
And
mean,
the
you
sales
know,
pitch,
I
delivered.
think we're
But
gonna always make it a part of our process, right? So like,
yeah,
our goal is try to raise the A round early next year or whatever. We're on track to do that. We want to make sure that there's a we funder portion of that, obviously.
yeah, I love that allocation of every round. That's our pitch. If you
Yeah.
are going the VC route, VC lead, priced around, signal, all good, board
Yep.
seat, add value in quotes, but then like allocation for the community every round. We love that. But so when you come to launch Nestment round two, what are the lessons you learned from round one, and also obviously on both sides, what worked well that founders
Yeah.
should replicate? What was kind of lessons you learned where okay, next time we'll do it this way.
Yeah. I mean, I think the things that we learned were um, let me think. I want to put this succinctly, but we learned that there's more opportunity out there than we realized for
Mm,
one. And and so I think we approached it maybe as like, oh, I think this will, I actually was thinking it was going to bring in more of my high net worth network, right, into it, right? And in some ways it did, right? It actually
mm,
also, a lot of those people didn't invest, which I was like, that's weird, like, but
mm,
what it did bring was a bunch of folks in the community I never knew who were going to invest, right? Like I didn't
mm,
even know how strong the WeFunder community would be, right? I was just thinking, okay, this is a mechanism to do that. So I think there was a few things that I would look at. One is I would almost tranche out like, okay, I'm making this specific push for our people who are connected to us as customers, almost to make people feel special along the way, right? Like
mm,
just making people, or like now I'm going to go out to the housing industry and say, hey, we're really focusing on the housing industry, and here's why. So it's just, I think, intentionality of maybe
mm,
staging it in a way that makes sense for folks. I think one thing that did actually work really well was, like I said, I didn't realize I was going to get these off-platform checks for 50 or 100 grand, right? And I think actually kind of playing that in a way where we're like, and announcing different, almost hitting different benchmarks to
mm,
folks, right? So like, originally we came in, we just were trying to get 250K, right? That's
mm,
literally what we were trying to focus on.
mm,
It looked like we surpassed that, and we knew we had surpassed that also because we had a couple off platform checks too. So now we could
mm.
we could celebrate 500K, right? And
Right.
then we had a couple more off platform checks, and then we had another little WeFunder bump too, and so now we
Yeah.
could support. So I think really being sure that you're celebrating these milestones, I think, is important. So yeah, and what I'll do is I'll put down all the notes that I took as I think more deeply about this. But I think the intentionality, really structuring this as a campaign. I think we did a decent job of it. You guys gave incredible support and guidance along the way. But I think we could take it one step further next time, right? And
Mm,
just really almost have it be outlined as here's what we're going to do. But because frankly, for us, this was a little bit of a test, right? A value
yeah.
aligned, mission aligned test. And so I think we prepared as much as we should have prepared for it. But now that we know and it's more of a known quantity, I think we're going to prepare even more for the next one.
Yeah, I love it. By the way, we didn't provide you great support because you guys, I've told you this before, but you were probably the most self-service founder and company that I've ever had. And we,
That's
we
weird
had the
because I
Slack
felt the
channel.
opposite. I was like, I'm telling. I
No,
was like,
not at
wow.
all. We were not Sherpery enough for you. We had the Slack channel. But I
Yeah.
feel like I would be messaging you like, do you guys want to meet like this week to chat about strategy? And you were like, nah, we got this. And
Okay,
I kind of,
there's one thing we should have done better is leverage the resources. I think also you guys connected this later with like an in-house, like a resident entrepreneur in residence and a writer who was helping with templates. And I probably should have reached out earlier and been like, "Hey, do you have these people too?" Right? So it was that they were awesome too. But
what's the
so
what's the lady on your team who was setting up the page again?
oh, Elena, yeah,
Elena, she was just like so on it.
yeah.
And she just like made the page herself, and it was so awesome, and she did it so quickly, and we were just like, here's the fundraising guide, and then she just did it, and we were like, wait, what, how did you do that? Like normally this takes like a month,
Yeah.
and like the WeFunder team was like heavily involved, and it's like you just were moving totally self-service super quickly and super brilliantly. So yeah, you were very delight to work with.
Awesome.
But yeah, I feel kind of guilty. I feel like we could have been more hands on, but I
Not
put
at
that
all.
on
Not
you
at all.
versus on us.
This year we're community now, so and I
Yeah.
look at community as we are all again trying to row towards this better future, a better society, and we're in the same community, so we're going to be working together in different capacities, and so learning about how to work and collaborate is all part of this. So I'm excited.
Well, that's an awesome note to end on. This has been such a fun conversation. Like, community is obviously so central to the way you're building the company. Even just you as a leader, I don't need to know you too well, but you just exude kind of community and good vibes and positivity in every interaction we've had, and I'm sure your team would echo that. So yeah, thanks so much for letting your community invest and letting WeFunders community invest in Nestment. And yeah, we hope to roll it back in the future as well as you go through the gears and go through the fundraising rounds. Thanks so much for taking the time to do this podcast interview as well, and I'm sure we'll be in touch soon, man.
Thank you, Johnny. I appreciate it, and I really do appreciate WeFunder and the whole team there. So this was great.
You're the man, Niles. Thanks. Bye.
I hope you enjoyed that conversation with Niles, genuinely one of the most positive and enthusiastic founders I have ever had the privilege of working with. To learn more about Nestment, visit nestment.com, and to view their WeFunder page, it's wefunder.com/nestment. Consumer fintech companies are the absolute bullseye sweet spot for community rounds. So if you're a founder building in that space and would like to learn more about WeFunder, you can visit wefunder.com/raise or shoot me an email at johnny@wefunder.com. Thanks for listening, and we'll see you next time.